The accounting equation, a very important concept in this chapter. It's made up of assets equals liabilities plus owner's equity. Assets are resources owned by the company. Think of car, truck, equipment, machinery, cash, inventories. Liabilities are obligations. Companies invest in assets like a building, like a machine, so that it operates and try to earn a net income for the period. However, it may not pay for the assets right away, but rather in a later period. And so it takes a loan. It finances. Think of your own situation. You need a car. However, you don't have 30 grand to pay off for the car to purchase at the dealer, so you would finance that, right? Put a $5,000 down, which goes into your equity. 25 then is financed, is a loan, it's a debt that you borrowed. So 25 plus the 5 equals 30, and 30 is the price of the car. So assets is 30, liabilities plus owner's equity is also 30, made up of the 25 in the loan, the obligation, a liability, plus the 5 in owner's equity, the down payment. The accounting equation balances, very important. Businesses often purchase inventories, however, may not pay for it this period. It would then pay for it in a later period, hopefully within 30 days. And so the current period would be an obligation, would be recorded as a liability. And that is a short-term liability. Other times when it purchased a fixed asset, such as a huge machine or a vehicle, then it would be financed and be a long-term liability. In either event, it would be payable, an account payable or a loan payable. Owner's equity, think of it as ownership. How much ownership does the owner have in the business? Ownership could come by way of putting money into the business, cash, or such as having a vehicle and putting that assets into the business. Let's say the owner starts off the company and puts in 30 grand into the business. So assets made up of cash is $30,000 and owner's equity is also $30,000. The accounting equation balances. And if it's not cash, let's say it's a pickup truck, and this truck is $15,000. So assets is 15, owner's equity is also 15. The total assets will now be 45, 30,000 from cash and 15 from the pickup truck. Owner's equity could be decreased if the owner takes money out of the business. This is called drawn. So let's say $5,000 was withdrawn, owner's equity decreased by 5, and this withdrawn is by cash, then the assets, cash, would decrease by 5. When the company operates using building, land, equipment, inventory, cash, whatever assets may be used, company tries to earn a profit and make net income at the end of the period. Any net income for the period would increase owner's equity. Here's another look at the accounting equation. Businesses have assets, resources owned. However, they may not have rights to all of those assets because let's say if the building was financed and has a mortgage, then the creditors, like the bank, would have rights or a portion of the rights to that piece of asset.